There's a tiny number that can change your rent, your job, your portfolio, and the survival odds of an entire banking system. It's not a law. It's not a vote. It's not a war. It's a decimal point. Here's what nobody feels in the headline. 2 rooms, same minute. In one room, a committee votes to move a number from 5.25 to 5.5. In the other room, a chief financial officer stares at a spreadsheet that says, refinance, in plain text. Because that quarter point doesn't hit everyone. It hits the people who have to roll debt. It hits the companies that live on floating rates. It hits the banks that look fine until their funding cost moves faster than their assets. And that's the trick. The decision is tiny. The leverage underneath it is not. So today I'm not going to ask, did the Fed raise or cut? I'm going to ask a better question. When that decimal moves, what breaks first? And stay with me, because by the end of this episode, you'll be able to look at a rate headline and quickly name the 3 balance sheets most likely to crack first. This is a financial channel. We don't do vibes. We don't do hot takes. We do the machine. First, quick translation. What does 25 basis points even mean? When people say, the Fed moved by 25 basis points, here's the plain English. A basis point is just 1/100th of a percent, so 25 basis points is 1/4%. It sounds small because it is small. But finance is built on small numbers applied to huge piles of borrowed money. So the question is never, is a quarter point big? The question is, how much debt is sitting there, waiting to be repriced? Why a tiny rate move can feel like a trap door. When the Fed changes its short-term rate, it's not directly setting your mortgage rate. It's setting the base price of short-term money in the system. Then that base price travels through the plumbing. Banks adjust what they charge. Bond markets reprice. Investors demand different returns. Companies feel it when they borrow again. Households feel it when they refinance, buy a home, or carry a balance. And here's the part that matters for risk. Some people have fixed rates. They're insulated for a while. Other people have floating rates. They get hit immediately. Some companies have debt due next year. They get hit now. Other companies locked funding for 10 years. They get hit later. So the Fed moves one number, and the economy responds like a room full of mousetraps snapping at different times. Now the conundrum, why this is so hard to get right. Okay, why doesn't the Fed just set the correct rate? Because there is no screen that says correct rate. The Fed is trying to steer a moving economy with 4 major problems stacked on top of each other. 1. Delays. 2. Bad gauges. 3. Invisible targets. 4. Finance can snap instead of bend. Let's make that easy to picture. You're driving at night in thick fog. You turn the wheel, but the car responds later. Sometimes it responds a little. Sometimes it overreacts. And your speedometer updates after you've already taken the exit, and then corrects itself later. That is monetary policy. The data arrives late. Then it gets revised. Then you realize the real economy was weaker or stronger than you thought. And by then, the rate move you made months ago is still working its way through the system. So yes, it really is like driving with a rearview mirror. Not because they want it that way, because the windshield is fogged by reality. Before the mistakes, the 3 balance sheets that usually crack first. Remember the promise. When you see a rate headline, you'll know what to watch. Here are the 3 balance sheets that usually show stress first. Number 1. The refinance balance sheet. That's any household or company that has to borrow again soon. If you have a big loan coming due, you don't care what rates were last year. You care what rates are today when you have to roll it over. If you want one phrase, it's this: maturity wall. A lot of debt coming due around the same time. Number 2. The floating rate balance sheet. Some debt resets as rates move. Think adjustable rate mortgages. Think some business loans. Think some private credit deals. If your interest cost resets quickly, then rate hikes hit you fast, even if your income doesn't rise fast. Number 3. The mismatch balance sheet. This is the sneaky one. It's when you fund yourself short-term, but your assets are long-term. That's common in banking. You borrow short, like deposits or short-term funding, and you own long-term stuff like mortgages or bonds. If short-term funding costs jump fast, and your long-term assets don't reprice fast, you can look healthy until you don't. That's the skeleton of a lot of financial blow-ups. Keep those 3 in your pocket: refinance risk, floating rate risk, mismatch risk. Now let's talk about the Fed mistakes that show why this job is so brutal. Spectacular mistake. Late 1920s, tightening into fragility. Late 1920s. The stock market is hot. Speculation is everywhere. People talk like the party can't end. The Fed sees the fever and tries to cool it. It raises rates to slow the mania. That sounds responsible. But here's what made it dangerous. The world was tied together by the gold standard. So the Fed wasn't just tapping the brakes in the US, it was tugging a chain connected to other countries' money and credit. When the US tightened, other countries felt pressure to tighten too, or lose gold reserves. The decision wasn't just cool speculation, it was tighten the world. And the painful part is you don't get instant feedback. You don't get a dashboard alert that says, global tightening cascade initiated. You get the bad news later, slower spending, weaker production, rising stress. Rearview mirror. Spectacular mistake, 1931, defending the anchor while the system was failing. Now it gets darker. 1931, bank runs, fear, gold outflows. Everyone is watching confidence like it's oxygen. Inside that framework, defending gold and defending credibility felt non-negotiable. So the Fed raised rates again. Say that out loud and feel how crazy it sounds. Banks are failing, and money gets tighter. The logic wasn't cartoonish, it was institutional. Protect the currency, stop the outflow, keep the anchor. But the anchor was chained to the patient. You defend the anchor, and you starve the patient. This is the central tragedy of policy frameworks. A move can be correct inside the rules, and catastrophic in reality. Spectacular mistake. 1937, tightening too early and snapping the recovery. Mid-1930s, the economy is recovering, not strong, but improving. Policymakers start to worry about inflation coming back. They worry about excess reserves. They worry that easy conditions will cause trouble later. So financial conditions tighten, and the recovery buckles into another recession. This is where you learn the hardest lesson in macro. The cost of being early can look the same as the cost of being wrong. Because when you tighten too early, you don't just cool demand. You can break momentum. Businesses stop hiring. Projects get canceled. Confidence flips. And again, you only see the full effect later. Rearview mirror. The biggest credibility failure. The 1970s. If you want the era that scares central bankers the most, it's the 1970s. This is where credibility got cooked. Inflation rose, the Fed tightened, then loosened, then tightened again, then blinked again. Stop and go, stop and go, stop and go. And here's why that matters in plain language. Inflation is not just a number, it's a story people believe. If workers think prices will keep rising, they demand higher pay sooner. If companies think costs will keep rising, they raise prices faster. If everyone expects inflation, they behave in a way that creates inflation. It becomes self-feeding. Now here's the rearview mirror punchline. In real time, policymakers were using estimates of how much slack the economy had. Slack means how much room the economy has before it overheats. Those estimates were wrong in real time. So policy looked reasonable in the moment, but in hindsight, it was too easy for too long. This is why just follow a rule doesn't save you. Rules still need inputs, and the inputs can lie. The controversial one. Early 2000s, cheap money and the behavior it unlocks. Early 2000s, dot-com crash hangover, fear of weakness, fear of disinflation. The Fed keeps rates low. Later, a major criticism becomes too low for too long. Here's the simple mechanism. Cheap money compresses yields. When returns are low, investors reach. When investors reach, leverage grows. When leverage grows, people start believing risk is normal. And if you combine that with weak lending standards, you can inflate something that looks safe into something explosive. Now, fair point. The right rate is not obvious. The neutral rate is not printed on a label. Global money flows matter. So yes, there's debate. Economists can argue about it forever, and many of them do, and they bring charts to parties, which is how you know something has gone too far. But for our audience, the takeaway is clean. When money is cheap, leverage finds a home. When money gets expensive, leverage reveals where it was hiding. 2008, choosing which fire to fear. 2008, stress everywhere. Markets wobbling, trust evaporating. The Fed is balancing two fears, inflation fear and financial stability fear. And in moments like that, the worst part is not that you might be wrong. The worst part is that both risks are real at the same time. If you focus on inflation, you might tighten into a fragile system. If you focus on stability, you might look soft on inflation and lose credibility. And markets do not wait for your committee to feel emotionally prepared. This is the nightmare mode of central banking. You're choosing between bad and worse, and you don't get instant results. 2021 and 2022. Transitory, then not. Post-pandemic inflation surges, supply chains, labor shifts, demand shifts, everything moving at once. For a while, the story is, this will fade as the world unclogs. Transitory. But inflation broadens, and then the response has to catch up. Here's the lesson that matters for your life. Models trained on normal times can struggle in a regime change. Forecasts can miss. Even smart people can be wrong together, at the same time, in the same direction. Rear-view mirror again. So what makes the rear-view mirror problem unavoidable? Let's pin it down in everyday language. 1. Delays. It takes time for higher rates to show up in hiring decisions, home buying, business investment, and defaults. And the delay isn't consistent. Sometimes it's quick, sometimes it's slow, sometimes it hides, then hits all at once. 2. Revised data. We talk about the economy like it's a live scoreboard. It isn't. A lot of numbers come in late and then get corrected. So policymakers are working with a messy draft of reality. 3. The invisible target. People talk about the neutral rate like it's a known setting. It's not. It's an estimate. It moves with demographics, productivity, and global money flows. So the Fed is aiming at a moving target in fog. 4. Finance snaps. This is crucial. The real economy is often slow and squishy. Finance is fast and brittle. When confidence breaks, the move is not gradual. It's sudden. Refinancing windows close, liquidity disappears, spreads blow out. Things that were fine yesterday become not fine today. 5. The mandates. The Fed cares about inflation and employment. Sometimes those goals point in opposite directions, and financial stability lurks underneath both. Like a third mandate nobody wants to say out loud until it's too late. Now cash the promise. When rates move, what breaks first? Let's turn this into something practical. Next time you see a headline that says the Fed raised rates, here's a simple mental checklist. First, who has to refinance soon? Look for big debt maturity walls, companies with large piles of debt coming due, real estate owners who rely on refinancing, households with adjustable rates resetting. If you want a plain phrase, who needs a new loan this year? Because that's where the stress shows up first. Second, who is on floating rates? Floating means your interest cost changes as rates change. If your costs reset quickly, but your income doesn't, you get squeezed. This is where you see layoffs, cost cutting, and sudden, we're doing a strategic review, press releases. Strategic review is corporate for, the math stopped working. Third, where is the mismatch? Banks, funds, and institutions that borrow short and own long. If funding costs jump quickly and asset values drop, that can create stress fast. This is the type of stress that can surprise people because the institution looked solid on the surface. Can you fund yourself tomorrow? So if you remember nothing else, remember this. First, they break specific balance sheets first, and then the economy follows. The uncomfortable conclusion. When people say, how could the Fed get it so wrong? They usually want a villain. Sometimes the answer is scarier than a villain. Sometimes the answer is the nature of the problem, delayed effects, bad real-time gauges, invisible targets, a financial system that can snap, and two mandates that can conflict. That's why the biggest Fed mistakes rhyme across decades. Late 1920s, tightening into fragility. 1931, defending the anchor while the patient bleeds. 1937, normalizing too early. The 1970s, blinking until credibility breaks. The early 2000s, cheap money feeding risk behavior. 2008, choosing which fire to fear. 2021, believing the shock would fade quickly, then watching it spread. Different eras, same trap, solving yesterday's problem with tomorrow's consequences. Close the loop, back to the decimal point. Back to the decision, back to the tiny number, back to that quarter point. That decimal point is never just a decimal point. It's a bet. A bet on how long the lag will be. A bet on whether the data is telling the truth. A bet on what neutral even is right now. A bet that the plumbing holds. It's driving through fog, using a rearview mirror, and hoping the road behaves. So the next time you see a rate headline, don't just think up or down. Ask what they're reacting to and what they're trying to prevent. Because the risk isn't only the move, the risk is the timing. And timing is the one thing the rearview mirror can't give you. That's the conundrum. That's the danger. And that's why central banking is one of the hardest jobs in finance, even when everyone is acting in good faith. All right, your turn. If you were in that room, would you rather risk inflation slipping loose or risk something snapping in credit? Pick your monster and leave a comment. And please don't just write, "Money printer go brr." At least spell it correctly. If you want more episodes like this, simple language, real mechanics, hit like and subscribe. And send this to the one friend who says, "The Fed should just fix it." Yeah, tell them the fix is a rearview mirror and a fog machine. See you in the next